Every insurance company domiciled in the United States must complete annual and quarterly statements that are in compliance with statutory accounting principles. In addition, many insurance companies prepare financial statements in accordance with U.S. GAAP. I'd like to take a few minutes to briefly discuss each of these accounting frameworks and then talk about some of the key differences between them. So let's start with statutory accounting principles. The insurance industry is currently regulated at the state level. Before 2001, each state had its own set of accounting and reporting requirements. As you can expect, this made the reporting function extremely cumbersome for the insurance companies operating in various states. So in 2001, the National Association of Insurance Commissioners, or the NAIC, codified statutory accounting principles within the U.S. insurance industry. These principles are included in the Accounting Practices and Procedures Manual, which is updated and published on an annual basis. Various groups within the NAIC contribute to the additions or modifications to these principles. Now let's look at U.S. GAAP. Prior to 2009, U.S. GAAP consisted of several groups of accounting standards that were written by various professional accounting organizations. The most notable and recent one of these organizations is the Financial Accounting Standards Board, or FASB. FASB was created in the 1970s and continues to write the accounting standards used in the United States today. In 2009, various groups of accounting standards within U.S. GAAP underwent its own codification and are now referred to as the Accounting Standards Codification, or ASC for short. The U.S. GAAP framework has been designed to provide investors with useful information to assess and track a company's profitability over time. It does this by utilizing the matching principle, which allows a company to capitalize and treat as assets the raw materials and costs used to develop a product until that product is sold. At the time of sale, the expenses associated with the product are matched with the revenues, and then one can easily see how profitable that transaction was. In contrast, statutory accounting principles are designed to allow regulators to assess the solvency of an insurance company. Regulators need to determine if an insurance company is able to meet policyholder obligations. Therefore, under statutory accounting, the recognition of expenses are typically not delayed, as in U.S. GAAP's matching principle, and assets, which cannot be used to pay claims, are not admissible as assets. Let's take a closer look at some of these specific differences. Acquisition costs. These are costs associated with writing new policies. Under U.S. GAAP, these costs are deferred and amortized over the life of the policy. Under statutory accounting, these costs are expensed when incurred. Not admitted assets. Assets that cannot be used to cover policyholder obligations, such as office furniture or equipment, have no value under statutory accounting and are referred to as not admitted assets. U.S. GAAP does not include this concept. Receivables. Under statutory accounting, receivables 90 days past due must be not admitted, similar to office furniture. Under U.S. GAAP, an allowance for uncollectible receivables would be established and would be based on historical performance. Bonds and preferred stock. Under U.S. GAAP, bonds or preferred stock that are classified as trading or available for sale are carried at fair value, and if they are being held to maturity, they are carried at amortized cost. Under statutory accounting, bonds or preferred stock are carried at amortized cost, or the lower of amortized cost or fair value, depending on their credit risk. AVR and IMR. These are reserves that are unique to the statutory accounting, and more specifically, they are unique to life insurance companies. The purpose of these reserves is to reduce significant fluctuations within the investment portfolio's income and capital gains or losses. As previously mentioned, these are the more significant differences between U.S. GAAP and statutory accounting. If you would like to learn more, please contact your AAM portfolio management team, or if you're not a current AAM client, please reach out to AAM's Marketing and Business Development Department at 312-263-2900.